Okay. And I think people are going to come in. See, I love when the numbers show up.
We got 6.
It comes, people are.
Well, Michael Rosenthal doesn't count. Michael Webb. Almost Michael Webb doesn't count.
Okay, we start off with that joke. This is Ari Rosenbaum here with that, yeah, Mike's like, what, huh? Well, because Mike, you attend all the events, that's why. It's Ari Rosenbaum here with that 4K virtual conference number 6. I'm gonna already start losing track of the numbers. We're gonna have another one on October 23rd, another one on November 20th, probably something in December before Christmas. That 4K National Virtual Conference, the big event in January 21, 22. Walt Frazier is going to be our guest on day 1, Hall of Famer Walt Frazier, Knicks broadcaster. Day 2 will be a recycled guest from the very first, that 4K virtual conference. My close personal friend, I don't think he knows that, but my close personal friend, Dwight Gooden, will be the guest on day 2. We may throw in some other people. We'll see how it goes. You could sign up you can sign up. We're changing the early bird. It's going to expire on Thanksgiving Day, but you could sign up and attend for as little as $20.21. We're adding a lot of sponsors the last couple of weeks, and we hope that you can attend. Go to that 4ksite.com to sign up. And that's it for my marketing spiel. The next presenter, the very first presenter, is going to be Lyle Himbaugh from Granite Group. I hope people can see my screen. And of course, I always hate when that little Zoom thing takes care of my play from slideshow, but whatever. Lyle, how are you?
Good. Hi, Ari. How you doing?
Good. How are you?
Good. Everything good out in down in New York?
As good can be, I guess.
Good. Should I just start, or
yeah?
You want to say anything, or no?
No, start.
Okay. Well, everyone, hey, thanks for joining. It's a pleasure to be here again. Once with Ari. I'm gonna give you a little bit of an overview of what we believe is happening in the current retirement plan landscape, where we think the industry is going, some things that hopefully that you could learn and take with you in your practices to get new business, maintain business, and some things that you should probably a call to action to do. So, next slide, Ari. Okay. So right now, it's sort of interesting. I got a couple slides here that are going to tell you about what's happening here with the pandemic and how clients' behaviors have changed, and how people have done things. So one is how they affected investment behavior, and looking at some of it from a demographic point of view. Go ahead. So this slide is pretty interesting. It just says how many people are satisfied really changed. And you can see the 55 plus crowd, the people have been around a little bit and have been through a few cycles. They're the ones who did the least amount of changing. So within their portfolios and how they've changed their allocations. And you can see the ones that really did the most are, the ones in their 30s and 40s. So that, it just goes to show you that there's a real need for education out there. As we believe that if you have a portfolio that's right for you, you should probably stick with it. But you can see how people have been moving some of their assets around. Next slide. So here's sort of the impact, right? Of what's happening here. So you can see the trends are pronounced. They're looking to. This is a graph about how many people are planning to work. Further than they planned, right? So you can see the young folks out there are not really probably thinking about it, and you can see the people in the 45 to 54 the most are really think about how much further they have to work. In the 55 plus crowd is, they're the ones who probably saved, they've probably paid off their mortgages and probably did stuff. And so they're not, they probably think it is what it is at this point. But it goes to show you that there's a real opportunity here for advisors to really go after not only within your plans, but actually start reaching out to the individual employees of those plans as well. Go ahead, Ari. So as we come out of COVID, hopefully we'll be out of COVID even despite the regardless of these recent spikes. You can see that plan sponsors are just going to want more services. They're going to need a lot more tools. They're going to want to outsource a lot more things so they can really spend more time on rebuilding their businesses out there. So that really means there's going to be a lot more employee engagement that's going to be really needed going forward, because you really need to be the sort of outsourced CIO, the outsourced HR person who's really going to contact the employees. Go ahead there, and we'll just go. So we're just going to talk a little bit about engagement here a little bit. Next one. So, there are a couple different types of fiduciaries. In Grant Group's a 338 fiduciary, which means that we're basically doing the fund lineups and models, but everyone's a little bit different, right? So a 321, for those of you who don't know it, are for those you're sharing responsibility, sharing liability. 338 does it all for you. Not all 338s are equal. So some 338s will just give you a fund lineup. Some will do a model. At Grant Group, we have not only the fund lineup and the models, but we also have created some technology that allows someone to get a personal allocation for them as well. And then what we also do differently is that we allow employees to call us as well. So go ahead. So it's important to know where you want to be and what you want to do, and depending what level of service you want to provide. So you really need, what we found here in COVID is that it's been imperative to have a real engagement program, right? So it's, people are going to, you can see people are thinking about retirement, people are thinking about the markets. We did something like for the advisors that we work with, we did something like over 40 webinars in March, April, and May, right to the employees, and really giving them strategies in terms of, like, when the markets were really down, we told people to double up on their contributions now and not make them later, because we thought the markets were very inexpensive at that point, especially back in March and the beginning of April. We told them what sectors we thought were good, and it really was, really became very productive. So by having a good program and by constantly touching on the employees as well as the employers, you get people to, makes for a happy employee and a productive employee. Go ahead, Ari, sorry. So when you talk about engagement, you want to talk about, you want to be able to create things that, you got to really know your clients. So if there's a demographic need, if there's, if people are over 50, you notice that, and you can run it on your record keeper. And if the record keeper shows you that, you've got like 30 people that are over 50 and only 10 are taking advantage of the catch-up provision, start providing some, a fact sheet or something on what they should be doing. Start, addressing things like, on 2, we said, how to save money and getting out of debt. There's all kinds of programs out there and services out there. Even we outsource a couple things when we think it's important. Making sure you're giving out the right message for that person to really make an action and make sure they really understand what's in their account and what, so they can have a real idea of where they're going to be in 5 and 10 and 20 years from now. So, and the last thing is, you really want to make sure that you have good media. It's not about being on LinkedIn and doing all these things. It's about making sure you got to start thinking out of the box. We created videos, we do stuff for our clients out there and send them out. And we actually, a lot of it we do on behalf of our advisors. So really use technology, it's there. I mean, Zoom meetings are great, all this is good, but it has to be somewhat modified to meet the specific person of the plan that you're servicing. So next page. So I'm going to just segue here a little bit and talk about MEPs and PEPs. I think it's important to understand that, they're coming in January of next year. They're only about three months away here almost. And so I just want to give you a little brief, the difference. There's a lot of competition. I'm seeing all this, a lot of PEPs that are being broadcasted out here. And I just want you to know that, whether it's a MEP or a PEP, it's really like a bundled, it's a bunch of 401ks inside of one 401k. And with MEPs, which is a multiple employer, there's two types of MEPs. One's a closed MEP and one's an open MEP. And basically a closed MEP is like a chamber of commerce. That's a closed MEP because they're all members and they can all participate together. And then there's an open MEP, which is unrelated. But when you have MEPs, you have to do an individual 5,500. And that sometimes, which just like a standalone plan, except in a MEP, hopefully you're getting the economies of scale of having a bunch of plans under one. Well, what's new, what's been created now are PEPs. Those are coming. It's a pooled employer plan, and it's going to be just like an open MEP, unrelated employees, but you just don't have to do a 5,500. There's a few other variances, but that's really the big one out there. So just so you understand, if you have any questions on that and you want to get into the details, you can always reach out to me afterwards. The whole purpose of this is to really lower costs and defray, the employers do not want the responsibility anymore. So whether it's a MEP or a PEP, it really depends on the client, and it really depends on their needs. And maybe a MEP or a PEP is not appropriate. Maybe it's still a standalone plan might be the best choice. It just depends on the on who the employer is. So go ahead, Ari. Like I said, they just want to spend less time. They absolutely want more service. There is, I can't tell you how many times I've been on the phone the last several months, and employers just do not want to be involved. They just want to make sure they're protected, make sure their employees are being serviced, and they just want to get back to work. So it's really, they're going to be a permanent part of the industry going forward. So next, Ari. So I'm just going to give you a couple seconds on Grant Group. So we are, Grant Group started on just a basic principle of ethics and integrity. We just want to do what's right. So we decided back last year to set up a GGA multiple retirement plan for small plans, for people for plans of under 100, and it's just like any other private client or large plan that we have, and we invoke the same principles on how we manage money, and the end result is that we have a really good program. We made everything as simple and as successful as we can, and I'm going to show you that in just a second here. Go ahead, Ari. So what we do on the investment side is that we have a specific philosophy. What you got to look for when you're prospecting, you got to make sure that there's an investment policy statement, and make sure that investment policy statement is adhered to, right? So we have a quantitative and qualitative process that gets us into the managers that we want to hire and managers that we fire. And so, but we document that inside the IPS. That is for the protection of the employer. And it also, the way we look at it from an investment perspective, it also allows us to have a much smoother, consistent returns among the individual managers. Next slide. So what I think is very important to do inside of any plan is that you have to have individual defined individual sectors. All too often we see when I have an advisor sending me a plan, I'll see 2, 3, 4 large cap growth, managers. So it's really important to understand that, if that individual participant, bought the 3 or 4 managers, growth managers on September 2nd, he's not happy right now. He's probably down, 10 to 12% right now in the last 3 weeks. That's not diversification. So I think it's best practices is to make sure you have one manager per asset class, and that's what we do. And to make things a little simpler for the average person out there, because we believe that 90% of the participants, want something for them. All right, so we created models based from the individual participant. From the individual mutual funds that are there to make it nice and simple. Next slides. Ari, what you can do? You can open up my site. On the next page. You go to the next page. And I just think it's important. For people to get more of a personal allocation than having a product. When you have a product out there, it's a one size fits all. So especially when I know target dates are very popular. There's lots of litigation there from Jerry Schlichter recently on target date funds. But just think from a common sense standpoint, when you have a target date fund and you have anyone really under the age of 50 or 45, and they don't make an investment election, they're going to be defaulted into 100% equities. That's it. And that may or may not be appropriate, but that's for that individual. So Ari, if you can just launch the questionnaire. So what we do is a little bit differently, is that we will have to get this customization. Ari, why don't you just take the quiz? It's just randomly.
First time in Kansas City, I actually read through it and it took a long time.
I know. So I think it's more important to get them. So remember, we've created these models so people get a something that's very close to what meets their personal needs and goals. So Ari just took this, and he's got the conservative balance fund, right? So if the person does his own allocation, he's got 40% stocks and 60% bonds, right? So he knows that if he wants that and he does his own allocation, he can do that. Or because the site is password protected and we create one site for each individual plan, so it's not generic, because not all plans are the same, it will recognize whom the record keeper is, whether it's my friends over there at Schwab or my friends over at Empower or Fidelity, whomever, Voya. It'll show the record keeper at the bottom. They can log in, buy the model, and log off. And what we just did is delivered a personal allocation for free. There's no financial engines at 40, 50, 60 basis points. That's a huge cost savings, right? Big cost savings. And the other thing that we do, so if you want to click on the mutual fund style guide, Ari, right? You can just click on that. You can see that we do something very differently here as well, is that we list all the funds, not by alphabetical order, but from least aggressive to most aggressive, including the models. And we give them an idea of what's in there, because when you look at growth, no one really understands what growth is. People don't know it's Microsoft, and they don't know it's Amazon. But here we define and say, oh, there's Walt Disney. Everyone understands what Walt Disney is, right? Just go back to the site. Right there. So it's really important for, we're trying to give people some, education. The other thing we do, if you go up a little bit, Ari, on the top, just go under the categories, just scroll it. There you go. So we produce a lot of investment education. I think, places like Schwab do an excellent job at retirement education, and getting people to put away money and getting them to put away a certain amount. But where we come in as a 338, we help people say, okay, if you have to put in $200 per paycheck, we come in and say, hey, here's where you want to put it. So we come up with quarterly education, quarterly comment. This is stuff that we write, what we think on what's the market's doing. If you want to just hit quarterly education, Ari, right there, that's great. So this is a web-enabled site. So, when you send this out to employees prior to your enrollment meeting, they download it, save it onto their home screen, and it'll look and appear as an app. And here's something we wrote the other day. You want to click the read more, what we thought, what was happening in the markets, giving some people color, because we were just, the market's been doing pretty well. But if you want to go back up a little higher, Ari. So these are just comments. And what it does, this is an engagement tool. Just hit select language. We can also turn the site into any language immediately. And what the site does for everybody, for the advisor, is that it provides a source of engagement. So it gets them to gets the employee to call and ask questions. What do you think about this? What do you think about that? And it gives an opportunity for the advisor to get in front of the individual employees. All right, you want to go back to English since I don't read Cantonese or Mandarin? You know, so there's really, and if there's a language there that you need, we can always do that. The great thing about this site is I white label it. What you'll know is up here, you'll see the Rosenbaum law firm. So there's Ari. So we can put your employer up there or yourself up there. And if you hit the About Us in the top right-hand corner, Ari, right there, you'll see that you can, if someone's up at night and your clients are thinking, you take the cursor, go over, you know, that good looking picture of Ari right there. Looks like a Rembrandt, click on it. You get a little bio, and then there's a little envelope. So your client can email you at 11 o'clock at night. So when you get that email, you can respond to that person when you get in the office in the morning. It's been, I can tell you, we went from just several hundred or to several thousands and thousands and thousands a month, and we've had an enormous amount of interaction. With clients. I mean, I can't tell you, between the webinars and this system, it's been phenomenal for everybody. So I just want, I think, I don't want to belabor this, but this has just been a great tool, especially in this last 5 or 6 months. It's really, because we're real money managers. So, and that's how we're working. So, all right, let's go back to the presentation. I think that's good. And so if I can answer right now, Michael Webb said, are your model allocations customized, target date funds or something else, or how do you feel about customized TDS? I like, I don't really like TDS in general. I think customized TDS are better, than a traditional TDF. But, since you're talking to a money manager, I always believe giving a person the allocation they want and having constant contact with them. So if there's any changes in their life circumstances, hopefully the advisor is on top of it and they can make adjustments on that as well. Mike, I'll answer your question about private equity in a second, because we do a lot of private equity at Granite Group. So why don't we go to the next couple slides, Ari?
Sure.
Yeah, so yeah, let's go flip the slide again. We just talked about all that. So at the end of the day, GGA created a MEP, and what we did in our MEP, and we're going to probably most likely turn it into a PEP, is that we have, we're the 338, we have a 316. The 316 is an operational fiduciary. That means the employer doesn't even have to sign the 5500. It's totally customizable. The advisor, we're sort of, when it comes to the MEP, we're sort of the firm behind the curtain, and the advisor's in the forefront. The advisor can put whatever remuneration he wants on it. We have nothing to do with that. They're indemnified from us, we're indemnified from them, and we work directly and give full advisor support. So if there's a question from a client, the client calls the advisor calls us, and we'll spend as much time as necessary with the advisor to make sure there's accurate answers. We'll even create custom marketing pieces for the advisor to help for whatever the circumstances are. So go ahead, Ari, next one. So I just wanted to give a quick little example of what is. This is a plan that we took over earlier at the beginning of the year. It was a $3.5 million plan with 27 employees. So there was an admin fees of 21 basis points, and the fiduciary fees, they had financial engines. Their broker was charging a pretty hefty fee. And if you take that light blue box and sort of that lavender box, and you go over to the next column, you'll see that those admin fees went down to 11 basis points and 25 basis points. And the other person, the employer didn't even have a 338, so we upped it all. So, but when you look at those green boxes, the operational fiduciaries at 316, they didn't have that. We gave them customized allocations, and we gave them that website investment education for them to have for their company. So that was a lot more service at a much lower price. And that differential is where the advisor can put in whatever they want to charge for their service. We don't dictate what the advisor is going to charge. Some advisors are going to show up every day. Some advisors are going to show up once a year. So it's up to the advisor what they want to do for the level of service that they're going to provide. So we're very advisor centric. There are other organizations out there that are coming up with MEPs and PEPs that have said in the Wall Street Journal, and I think it was June 16th, that they are going to go forward with these types of vehicles, but the advisor is not going to be a part of the business model. So just so you know that. Next one. So, we're a partner. We're all about the advisor. We're about excellence, doing right by your clients, for your clients at all times. We're always accessible. I've been known to call people back on a Saturday if someone emails me back, because I don't want to wait till a Monday. So we can be prepared. So there's between the 338 having the fund lineup, the models, the technology, and having the advisor to call us at any time, we are totally committed to the success of the advisor and to the plan, by the way, most importantly to the next one. So if you have any questions, next one, Ari. There's a couple things, couple actions that, people are moving around. A lot of advisors have not called on their clients. So there's a real opportunity here for you to really go out and capture new business. This is about being proactive and not reactive. So if you need any help and you want to just chat, just give us a call and see how we can help you. It can be for the MEP, it could be for an individual plan, it could be for a pension. We're pretty well versed. So next one, Ari. So if you have any questions, you can reach out to me. You can reach out to Mike Rosenthal, that's what I've got to say right now. I just want to answer Michael Webb's question. Private equity. So we do a lot of private equity investing for our clients. We've had some tremendous success, especially this year and last year. We had really had a few grand slams for our clients that we invested in years ago. Private equity is very difficult. It's a very difficult concept. People do not understand the risks. Just because you put money into something highly risky doesn't mean that you're going to make a lot of money. It could also mean that you could lose everything. So, and I think really the problem as a 338, you really have to do some due diligence on whoever that private equity person is. You can't go into really angel investing. Those are 7, 8 year, 9 year gestation periods. You got to really think about it, and I think from who's going to be responsible for that? Because as a 338, and I am a private equity investor myself. I have a lot of my own personal wealth in private equity. I can tell you that it's very hard to explain. I think, there's got to be mechanisms on the record keeper side that would prevent some people from getting in if they didn't hear a certain risk tolerance or if they were close to retirement. Because if you're 6 years old and you're going to retire in 3 years, private equity is illiquid. You can't, it's not like you can get out of it, right? So it depends on what the structures are going to be. I don't know how you provide liquidity when you're making permanent investments that can't be sold in the public market. I think that's going to be pretty difficult to do. And I think, Michael, you're pretty astute. I look at what you're saying as questions. Ari's a conservative guy. What I can tell you, he scored. He has a score, but that's okay. If Ari wants to be, that conservative, that's what's right for Ari.
No, when we first started doing these things, I used to actually read it, and I was slowing down your presentation because I'm usually like a 99 when it comes to investing. So I just now indiscriminately.
So we're really we're investment guys. So we really do run money for entities outside of 401k. So if you have questions on the markets itself, feel free to ask me. Call me up anytime. This is what we do. We're really money managers inside of a 401k plan. All right. Thank you.
Thank you, Lyle. Next presentation is going to be our friends at Russell Investments, PCS, Millennium. I think that's everybody, right?
Yep.
Who's going to start off the show, I guess?
That's me. So, there you go. Got the presentation up. Well, thanks for joining. Thanks for inviting us to be on the conference, Ari. As Ari mentioned, I'm here with my friends at Millennium and Russell. We partnered together to create a retirement plan to provide participants with better outcomes, help plan sponsors lessen their administrative and fiduciary liability. That's through what we call our next generation retirement platform, which we're going to have Mike and James discuss a little bit here in a minute. For those that don't know me, my name is Chad Azera. I'm the SVP of Strategic Sales at PCS Retirement. We're a national independent retirement platform focused on helping America's retirement gap by equipping financial advisors with the most powerful, trusted, and easy-to-use retirement solutions available anywhere. Our partnership with Russell and their personalized retirement accounts and Millennium and their investment fiduciary solutions is what we believe is one of the most complete retirement plans in the space. We're excited to talk about that today. So, but before we hand it off to Mike at Russell, I wanted to introduce you to James Holland, for those who don't know him, and let him give you a brief overview of Millennium.
Great, appreciate it, Chad. Thank you. For those who don't, my name is James Holland. I'm a partner here at Millennium Investment and Retirement Advisors. We're an RIA based in Charlotte, North Carolina. Our sole focus is the qualified plan space, and 99.6% of our business comes from outside advisors who either are new to the space or are limited in their capabilities or the responsibilities they're allowed to assume with a retirement plan by their RIA or broker dealer. So we enjoy working with the folks over at PCS and over at Russell to try to, again, as Chad say, make this as easy as possible for both the plan sponsor and the advisor. And while we all do this to hopefully benefit the participant outcomes, one of the things from an advisor perspective is finding ways to make your qualified plan book of business more profitable by streamlining the not just the costs, but the services you have to provide, enhancing the technology, which we believe this does. So we try to, again, partner together with the folks who can provide the greatest level of protection, but also offer the support and the technology. From there, I'm going to turn it over to Mac and let him do his thing.
All right, thanks, guys. I really appreciate it. I want to start off with a welcome and thank you to everybody who's on the call. We really appreciate it. I also want to thank a special thank you to Ari. I have been fortunate enough to be a part of a number of these in the past in person, usually, and I did Cleveland last year. That was a great time. I've done them in New York, all over the country. But without question, my favorite one that I've ever got a chance to do was in Philadelphia for a couple of reasons. One, I know how much Ari loves Philadelphia and Philadelphia sports teams, especially the Philadelphia Phillies. So thank you again, Ari, for hosting in Philadelphia, because I know you really love Philly. I'll pause there in case you want to make a snide comment.
Now, the only event where I didn't wear a jersey. That's the only conference I didn't wear a home team jersey. So
I was going to mention that, but I figured I'd leave that one to you. Two, shortest commute for me. I live right outside of Philadelphia. I do cover national sales for Russell Investments on the retirement side, but I am based right outside Philadelphia. So Citizens Bank Park was an easy commute for me. So another thank you on that. But most importantly, I had a rare experience there. I actually had the Philly fanatic come over to me, sit me down in a chair at the end of that event, whip out his towel, polish my head up real good, and captured it all on video, which is still to this day one of my kids' favorite videos. And for those of you like James and I who have a Chrome Dome on the call, I would highly recommend a Philly fanatic Chrome Dome polishing. It really worked out nicely. So as these guys mentioned, I'm really excited to be part of the Next Generation Retirement Solution. Very grateful to be here, and thank you again for all your time. A little background on me. I've been in this space since 1999. I joined the financial services industry in 1999, so a little over 20 years ago. Really got into the retirement-specific aspect about 15 years ago. and have worn the 401k moniker with pride ever since. So I've had an opportunity to be part of many organizations as an advisor, as a wholesaler, as a sales manager, gone to many, many different conferences, sat in many finals presentations. I don't say that to try and give you a resume. It's more so I've had the opportunity to hear what I think works and what makes people the most successful in our space. And to me, that's finding ways to relate to your customer and differentiate what you're trying to talk about. I've often told the story about differentiation. I like to tell the story about Tom Monahan, who was the founder of Domino's Pizza. He built his entire business based on what he called his unique selling proposition, which was fresh, hot pizza delivered to your door in 30 minutes or less, or it's free. He built an empire on what I would say was average at best pizza. Why? Because he again, could identify with his clientele and figure out what was important to them and then give them a solution that met their needs. And I think we can think of a number of different examples that accomplish that, right? One that I can relate to kind of in a negative way is, can you hear me now? Or on Zoom, what we say a lot now, you're on mute, or unmute your line, we can't hear you. But can you hear me now? It was a genius slogan Verizon came up with to emphasize that if you don't want to be saying, can you hear me now? Can you hear me now? Come to us. We don't have that issue here. We have great cellular connection. Another one is FedEx, when it absolutely positively has to be there overnight. Again, relating to their customer and really driving home what's most important to them. When you really need to depend on us, come to us, because we will get it there overnight. These are all, again, unique selling propositions that the companies are trying to emphasize to their client. This is what we're delivering here for you. I would encourage everybody on today's call to really think about that. Really think about, how can you relate to your customers? How can you relate or differentiate yourself in the solutions that you're bringing? Because I think that's what makes us most successful in our space. And we're going to share some ideas with you here today that we think we can help you do that. Ari, we're going to move to the next slide, if you don't mind, and that's a compliance slide. So we'll leave it up for a few seconds so everybody can memorize it real quick, and then we'll move on. All right, we're ready for the next one. So what's the next generation retirement plan solution, and what's the makeup of it? Where do we fit in, but where do the other players fit in as well? So it all starts at, as Chad said, we feel this is a complete retirement plan solution for defined contribution plans. At the top, we think you're the most important, the plan advisor. You're going to be what I would describe as the general manager of this relationship. You're making sure the offense, the defense. I played and coach football now. I want to make sure my offense is running properly, my defense running properly. So I see that as your role as the advisor. You have the main contact and relationship with your client, and you're monitoring all the various components to make sure everything's working correctly. Millennium is there to, again, help with regulatory guidelines, make sure everything's running properly with respect to compliance. And they also serve as what I would say is the plan level 338. By selecting the investments. It's an open architecture investment, but selecting the investments, making sure they're still appropriate for the plan, and when they're not, switching them out or terminating the ones that are underperforming. Really excited. I've been working with PCS for over a decade and have a great relationship with them. I formerly was at Charles Schwab. I worked with over 140 different independent open architecture record keepers and TPAs. I could recommend anybody I wanted to. PCS was by far my default and favorite partner, one that I would recommend with confidence any day. We're glad to be partnering with them. They do a great job on the record keeping side. Again, it's an open architecture platform, various custodial agreements there. So I think that they really, really check the box in terms of service, cost, everything, just a complete check across the board for PCS. And then where Russell comes in is, we're the investment manager. We come in and we offer what are called personalized retirement accounts. And personalized retirement accounts, we're going to talk about in more detail as the presentation goes on. But in short, as James is operating as the plan level 338, selecting the investments and monitoring and taking that responsibility, Russell is actually offering a participant level 338. So we are taking data directly fed to us from the record keeper and building custom asset allocation models for and recommendations. It's a managed account for each individual participant in the plan. And again, that's a 338 at the individual participant level. Ari, if you could be so kind, and we'll move into the next slide and talk about, Lyle touched on this as well, and this is no surprise. We've seen evolution and we've seen QDIA solutions evolve over the past few years. Kind of started out with the single manager target date fund. And look, I want to just throw out a caveat. I am not here with an agenda to pick on target date funds. I have sold them. I think they've done some good in the industry. They've gotten people invested and gotten people started. And I'm eternally grateful for that, because we know the earlier you start, the better. They're simple. Most people can figure out how old they are and what corresponding series of target date funds that means they should be in. But I do feel they are limited. They factor things into one data point, and that's their age. And as we'll see throughout the presentation, there's a lot more that goes into the equation than age. And we have some charts here that will discuss how different circumstances like salary and account balance and contribution rate can have massive, even market experience can have massive effects on your outcome. So PRA, or personalized retirement accounts, are designed to get you to your targeted retirement income goal in a complete, comprehensive, and robust way. Continue along this path. I think larger plans started to realize that a single manager target date fund over the years was limited. And so we saw more of an institutional strategy and then moved to custom target dates. Again, we feel here, and it's our opinion, that personalized retirement accounts are the most robust and comprehensive solution on the market today. I just want to touch on something real quick. That's not just our opinion. That is also, we see industry trends of managed account utilization continue to trend upwards in a significant way. Yesterday in particular, I'm sure most of the people on this call are familiar with the 401k Wire, and I'm a subscriber to that. I get their daily post, as many of you probably do. Yesterday, Thursday, September 24th, there was 4 articles highlighted, only 4, on the 401k Wire. Every single one of them pertains to managed accounts. I think that is another proof of concept that this industry and plans and plan participants are continuing to see the value in a managed account solution, which is great news. All right, let's move to the next one, Ari. We're going to talk about where we see target date funds and how they can be approved. Again, target date funds, I'm not here to bash them. We all know number 3, obvious, that goes without saying. They're based on age, right? Target date. And as I said, most people can figure that one out. They don't require any participant input or engagement, and that's been why they've been so easy. They're the easy button out there. They do offer a little bit of a diversified portfolio. Depending on which one you're in, you could argue that they have reasonable costs, and they, of course, do meet the QDIA requirements that were set forth in the Pension Protection Act of 2006, which Ari, unless something's changed, qualified managed accounts, target date funds, and balanced funds is eligible as QDIA requirements. Ari, I saw you unmute. Do you want to comment?
It's correct. There's been no change.
Good. Where they fall short, they only factor in, again, that participant's age, and that's not taking into account any other factors, gender, salary, account balance, contribution rate. So ultimately, we're going to look at that on another slide. And really, I think you've seen in March, Lyle did a good job of talking about COVID and how the markets have responded. We had a deep drawdown in March. A lot of people were very unhappy with the target date performance in March, and then we had a quick rebound. So I'm not going to get into a debate or argue have they held up throughout market experiences. I think it can be argued and a lot opinionated, but I think you can make a strong argument that they haven't held up in a lot of markets. Next slide. This just talks about PRA at a high level. We've kind of covered some of this already, but these are customized portfolios. I would argue that if you were to ask most participants what matters most to them with respect to their 401k, and you took all the answers and simplified them, boiled them down to the simplest result, you'd get something of the effect of, I don't want to run out of money when I retire. I want to make sure when I retire, I have enough money. As the second bullet points out, this is the whole intent of PRA. We're targeting their retirement income and trying to increase the likelihood that they'll reach it, again, with a customized portfolio specific to them, not just based on their age, but their individual circumstances and the market fluctuations. We can move on to the next one. So this is how it works. So as I mentioned earlier, on your right at the top, you'll see what we factor in at a bare minimum. We do factor in age because we do feel it's important, but we also factor in gender. We're going to look at deep or a little bit more descriptions on the next slide, but gender, salary, account balance, and saving rates. And you'll see on a couple slides in how those things can certainly affect. What PRA does is then determine how can we replace your income. And we're targeting 100% of after-tax take-home pay at retirement. So how can we get you to that? And then ultimately recreate the portfolio and adapt it quarterly to again, adjust on market fluctuations. I see a question on here and a couple chats. I promise we will save time for that. We'll get to that at the end. And Chad, James, and I will tackle and try to address any and all questions. But in the sake of time, I'm just watching my time here. I want to make sure we get through the slides. We don't have too many, so again, I promise we'll save some time. All right, can we move to the next one? This next slide is going to talk about why we factor those factors in above and beyond age, and why we think they're important. Age, again, of course, is going to be, we don't even have to discuss that. But as the top of this topic slides, a lot of the reason that I think target date funds have been so popular in the past is because you need data to create a customized and personalized asset allocation recommendation. It hasn't always been easy to get. A lot of participants haven't been engaged for whatever reason. And so, they don't want to fill out a lot of times risk tolerance questionnaires or provide data. That's what makes this so beautiful. We are fed these data points automatically through integration with PCS and the record-keeping system in the next-gen retirement solution. We're automatically fed a participant's age. We already talked about that. Gender, why? Well, because we know through actuarial tables that women tend to live longer than men, so we factor that in. Contribution rate, of course, the more you contribute, the better shape you're going to be in, and we'll make recommendations on that. Your current account holdings, your salary, all are important things that we all are factor in. And then for those participants who do want to engage, you can actually go into what I'll show you a couple slides from now, so what's called our PRA Planner tool. And you can put in additional information like, do you have a defined benefit plan? Does your spouse have a pension? You can pull in, we have an aggregation tool in the PRA Planner tool. You can pull in accounts from Charles Schwab or TD or Fidelity or whatever. We have aggregation and integration with, you can be pulling these accounts in and factoring them into the equation if you'd like to. That is not necessary. That is not required. That is merely optional. If you don't do that, and it's A-okay if you don't, we still are going to be factoring in the top 5 on this slide and building a much more robust asset allocation recommendation. Let's move to the next slide, please, Ari. So this is what I was referring to earlier. And I'm 45 years old, and I always like to reference, my friend's situation. One of my best friends is 45. He's single, lives by himself, has no children. Just because we are the same age does not mean that we have the exact same circumstances across the board. And participant A, B, and C is a perfect example of that. I like to start off on the right of this and talk about, look, if you're participant A, B, and C in a traditional plan with the target date fund as a QDIA, everybody, regardless of all the other circumstances, is going to be sitting in that target date 2035 strategy that's not factoring in any other customized or personalized data into the mix. We already talked about, you'll look on this slide, there's some big differences in salary, contribution rate, account value, and so we look at that and say, well, what's that most importantly result in the projected funded ratio? And as you'll see, participant A is 50 years old. She's well under her projected funded ratio. So we want to have a higher allocation to growth for her to get her back on track. Participant B, he's right on track. So his mix is going to be different, and participant C is over, and so of course his recommendation is going to be different. But again, you could have as you'll see, very different salaries. Participant C is double the salary that or account value that participant B is. The salaries can be very different. You can be pulling in other information or previous 401ks. So we're trying to factor all that in and not just base it on, hey, you're 50 years old, so you go in this portfolio with every other 50-year-old. We know that there's a lot more to it than that. Next slide, please, Ari. Okay, so this is an example of a report that we can provide, and we do provide. We have other reports, but it helps a plan sponsor really track where their participants are in terms of their retirement readiness. I know this slide is hard to see, but it kind of gives a grasp of who's on track, what the contribution rates are, and just other recommendations and what we have that can help them improve their outcomes. So that's one of the sample reports. We have many others. I want to move to the next one, which is the actual snapshot of the PRA Planner tool. And let me make an offer to everybody on the line here. I can walk anybody here through this in a live demo setting in under 5 minutes, and we can show you exactly what happens. But let me just hone in on a couple of things. There is no cost to add PRA to a plan at the plan level. So you add PRA to the plan, no cost to the plan whatsoever. Okay? Everybody in the plan, whether they're enrolled or not, then gets access to what you're looking at right here, which is called the PRA Planner tool. This is designed to specifically, again, help them determine where they are at. Are they behind, on track, or ahead of the game by pulling in the data fed to us inside the Next Generation Retirement Solution through the record keeper. So all their data is going to be in there. And within a few clicks here, we're going to get a determination of where they stand, and then they're going to get a proposal of how they can improve their chances. Some of those suggestions or recommendations do not require that they enroll in our service or PRA. And if they don't, there's no cost whatsoever to any participant who's not in. Those recommendations might be, hey, you want to delay your retirement by a few years, or you want to increase your percentage. So there are recommendations here that can improve the retirement readiness of the plan overall without even engaging in PRA. For those who see the value in the personalized retirement accounts, they will have the option to review the proposal and enroll into the service. Like I said earlier, managed accounts have been steadily increasing in popularity. That means that there's other solutions out there. We're not the only game in town. But what I will tell you is this. When we look across the industry, a lot of the big box providers and other providers out there, the cost that they are charging for a managed account solution is typically 2 to 3 or more times than what we're charging for personalized retirement accounts. So again, free to add to the plan, no cost if you're not in it. And for those who see the value, go in it, they get it at a fraction of the cost of the industry standard. No matter what, everybody gets access to the PRA Planner tool, and they're at the very least going to have a tool at their disposal to determine where they're at in terms of their retirement readiness and some suggestions of how they can improve that. Okay, so let's just move on to the last, which is the summary slides. And as promised, I see a ton of questions and chats on here, so we will address those in a minute. I just want to kind of rehash and summarize here. Again, PRA or personalized retirement accounts is relevant. It addresses what's most important to retirement plan participants. And the key is it requires no interaction on their behalf. It gives them an estimate of what their retirement income goal and how they can get to that goal. Automatically gives them a personalized, robust, comprehensive asset allocation recommendation and rebalances that on a go-forward basis. And it includes the PRA Planner tool, which you can further customize your account. So we think we have a great differentiator here. We know that it's relevant. We think you can relate to your client and differentiate yourself with the Next Generation Retirement Solution. So with that, as promised, I think we have about 5 minutes for questions, so we're right on schedule. And if Chad and James want to unmute, well, it looks like you are. maybe we can address these. This looks like the first one's to me, so I'm going to read it out loud. And says, Michael, how do you prove that managed accounts justify their added cost by performing better net of cost than target date funds and even customized target date funds at the part? Isn't that hard to do? It's a great question. And what we tend to focus on is typically the mindset in benchmarking most strategies is you go onto an FI 360 or an RPAG or something and do an apples to apples comparison. And it is a little harder to do with managed accounts because why? Because they're personalized. So every individual in a plan and every plan essentially can have a different outcome. So it is a little harder to benchmark. So what do we focus on? We focus on, again, what we think is most important, outcomes. Again, what's most important to a retirement plan participant? Am I in good shape and will I not run out of money in retirement? So we're trying to show them which we think is more important to them than I was up 15% last year and down 10% this year and this and that. I'm a former advisor myself. I've always found that conversation interesting when somebody says to me, and I had a lot of calls in March from friends and family, what do you think I should do? I had X in my account, now it's down to this. You didn't have X unless you liquidated at that point, and you don't have X unless you liquidate right now. You had a performance number, and you had an account balance that goes up and down, but the only day it really matters to you is the day you liquidate, retire, and now you have to figure out, is this enough money for me to get me to my finish line? And so again, that's why we feel that focusing on outcomes versus percentage on a yearly basis is a more relevant and pertinent way to look at it.
Well,
James, Chad,
Mac,
did you want to add anything to that?
Well, Mike, one of the things they can provide, so Russell has done some white paper work and some studies with regards to the performance of the PRA to target date funds, which we can provide for anyone that wants to get more granular. So there is some data to back up Mike's statement there for the folks who, if it does get to that technically detailed from a conversation standpoint. So
we actually have a white paper that talks about how to evaluate and the methodology we utilize to evaluate and measure managed accounts, and I'd be happy to share that with anybody who would like it. I can share, I'm looking at some of the comments here on the chat. One that I'm not surprised at all, and I take it in good faith, or I take it jokingly, is the Philly comment. I'm always used to getting ripped from being Philly. So yes, I am seriously from Philly, and I thought that was the best one. But ultimately, offer one. I'm happy to schedule a demo with anybody who'd like to see the tool. I'm happy to make the slides available, and I'm happy to send out the white paper to anybody who'd like to see how we've written this white paper on measuring managed account performance, and we could certainly do that.
Cost, price.
Good, Chad.
Cost. So if you're the QDIA, if PRA is a QDIA, it's 25 basis points for any participant that actually uses the solution. If it's a non-QDIA solution, it's 30 basis points.
But that is also tiered, excuse me, with regards to plan assets, and the benefit of the relationship with PCS is it's across the board at PCS. So it's not just the plans you're working on as an advisor. So as all assets in the next gen on the PCS platform increase at certain thresholds for all of the plans, the price then tiers down. So it's not just based on the plans that you are working on individually. So there's a little bit of a benefit there as well.
Yeah, and we did review other solutions, and my relationship with Mike notwithstanding, it was the most cost effective in the marketplace also.
Great. So I think we're close to time. I see a couple more questions. Let's try and get to those. Thanks, guys. I hadn't gotten down to the cost one yet, so thanks for being ahead of me on that. Yes, so have our studies shown that the outcomes are improved, or too soon to tell? Yes, we do have stuff, and I can show you that over 90% of time periods we looked at that PRA gives a better performance, and I'm happy to do that. And can I get Chad's contact information, please? You know, why don't we do this? Why don't we just, if you don't want it, you can always delete the email, but why don't Chad, James, and I work together to get you some of the follow-ups that are on here, and we'll get a list of the attendees and send it out to everybody. And if you don't want it, you can certainly throw it in the trash. But that way we'll get everybody covered. And if nobody objects to that, maybe that's the best way to proceed.
Yeah, agreed.
All right. So the three of us will circle back on a follow-up to send out to everybody. We'll get some of those white papers and resources. If you want the demo, let us know. We'll have our contact information on there. Again, I can't thank everybody enough for your time on a Friday. Really appreciate it. That's all for me. James, Chad, if you have any other comments, feel free to throw them in. But again, Ari, thank you very much. Next time I expect to see you in a Phillies jersey. And thanks again. Have a great weekend, everyone.
There's a better chance of me wearing an ISIS jersey than a.
Yeah, no, I agree. I agree. Good call, Ari. Good call. Thanks, guys. Appreciate it.
Thanks. Let me just clear off my screen here. Next presentation is Roger Jorgensen from Alaris, who's going to let us know about one of the best secrets in what I think is one of the best secrets in the retirement plan business, and that's HSA accounts. And quite honestly, these days, probably better than a 401k plan, especially when it comes to dealing with costs. And did I get it?
Yeah, that's it.
Okay, I just want to make sure.
Yeah, and I'm sorry, there's a lot of flipping through there when you get to that because I
almost killed the meeting. That's the problem.
Oh, otherwise I could share it if you want me to.
No, I got it.
Okay, good. All right.
The problem with the Zoom thing is it's right on my slide.
Exactly. I know. I got it.
Yeah.
Yeah. Okay, I'm going to start out by talking about Walt Frazier, Ari, since you mentioned you got a conference and he's going to be a guest. In 1972, they won the NBA championship, and in 1973, I was at Kutcher Sports Academy in upstate New York. And Walt drives in a Rolls Royce, pulls up to the door. There's about 300 campers, you know, applauding him as he arrives. He walks out in a full-length mink coat, gets out. He's got two Dobermans, one on each arm, and then he's got about 3 women get out right behind him. And then he yells, any of you chumps want my autograph, come on down to the main hall and I'll sign them for you. And that was the beginning of my experience with Walt Frazier, one of the most colorful guys in sports. So anyway, I just wanted to throw that in there. I've been doing HSAs for well over 16 years. So you can flip the 4 times through the agenda. I'm just going to talk about where are we at today with HSAs. You know, how do the HSA users view their accounts? I've done countless education meetings on HSAs. I think I got a pulse on it. I've also been working with advisors more recently in the last 2 years. I'm going to talk about that. I'm going to also talk about HSAs in the retirement. You 45-year-olds have no idea what it's going to cost for healthcare with Medicare and Medicare supplements and Advantage plans. So I'm going to cover that a little bit. I just think it's good for I know with our wealth manager, he's about 10 years younger than I am, maybe 15. And I just went through it to him and he had no idea. So he told me he was going to start talking to some of his clients about their HSA and how that can work on their behalf. So that's what I'm going to go through. So the next slide, Ari, you know, really is talking about how many HSA accounts are there now? Now there's over 28 million HSA accounts. You know, when we started in back in 2004, marketing and doing HSAs, you know, the thought was if we got over 5 million accounts, they'd be safe from being repealed. Well, now we're at over 28 million. And next slide, please, Ari. So, and that's 66 billion, over 66 billion in assets, right? Of which the 66 billion, only 16 billion, next slide, is actually invested. So why is that? So that's what I want to talk about today. I want to go through it. 16 billion invested, leaving the other 50 billion sitting in cash, right? It's only 24% of HSA assets. On average, the balance is $16,000. I know people have $125,000 balances in their HSAs that began at their inception. And so the balances by some individuals can be significantly higher, but notice it 7 times higher than someone who isn't investing with their HSA. And part of that is because they get it. You know, the people who understand the value of the HSA in their retirement are putting more money in. Next slide, please. So, you know, here's an interesting slide. I came across this, and I think there's more explaining to do about it. But 56% of accounts have been opened in the last 3 years. And to me, that's movement. People are moving. They initially started, they might be at the local bank. They've got no investment options. We've taken over accounts because of our investment options, only to find out they had investment options. They didn't even know it because they never talked about it, because their insurance broker never really took the time to explain it to them. And that makes sense because they typically don't get paid on it. So it's just an ancillary product. They just provide HSA vendor or steer them in the right direction. Notice 37% of assets held by the accounts in the last 3 years. And I think that's also movement, right? Because those accounts that were open really they're coming from another place. And so that data is skewed, but it shows me that there's movement, and it shows me that employers are moving for a number of different reasons. Next slide, please. So, you know, just I like to incorporate the education. I read this thing at one point where advisors said really what they wanted was more education on HSA. So I just incorporated into this. But, you know, and we all know this, but there's a triple tax advantage, right? No tax going in, no tax on the accumulation, no tax going out. It's a trust. It's their money. It's established in their name. At termination, you know, it's still their money. At retirement, still their money, better than a 401k. And at death, this was my wife's favorite. At death, the money goes to the spouse as an HSA. Anybody else is a taxable event. Next slide, please. So, you know, I really break down, you know, who's got HSAs, how do they view the HSA? And a lot of this has to do with the education that they're being provided at their employer. So these are the 4 kinds of vehicles, and I'm going to go through this. The next slide, please. You know, for most people, it's a pass-through account. There's pre-tax savings, right? They know that. No state, federal, Social Security tax, Medicare tax, with the exception of a couple states. They're going to use it to pay for their out-of-pocket expenses. I'll go through the eligible expenses in a second, but far more than just a typical insurance plan. Right? They kind of use it like the old flexible spending accounts but there was a use it or lose it. Now they can have a rollover on those accounts, but for a lot of people, that's what they remember, and they kind of use it to pay for those expenses. They might not take the money out right away. They might wait till when they get closer to the holidays and they're going to be buying presents, and then they might decide to take those expenses out, and so that they have some cash. Over 90% of the accounts are these pass-through accounts. You know, where people really don't understand the value of the HSA. Next slide, please. Yeah, so contributions, I mentioned, they're pre-tax. You're limited how much you can put in the HSA. This is indexed for inflation. Originally, it was $2,500 back in 2005, $5,000 for families. So it's gone up, $3,550 if you have single medical coverage, $7,100 for family. If you're 55 or older, you can do a catch-up contributions. One of the educational components of the HSA is you can change your contribution at any time. So if you have employees who are underfunding their account or have an expense that they weren't expecting, they can just notify payroll and change your contribution and increase it and set up a payment plan and pay those expenses. That's some of the help we provide in terms of education of employees with their HSAs. Next slide. So in terms of distributions, you can take money out of your HSA at any time for any reason. It's never taxed if it's for a qualified distribution. If it's not a qualified distribution and you're under age 65, there's a 20% excise tax. But notice at 65, the 20% excise tax goes away. So essentially it works just like a 401k. You can spend it on anything you want and you'll pay tax as you draw it out. Next slide, please. Yeah, but you don't have to take the money out. So if you bank expenses, and I try to encourage every employee, set a threshold. Do you need, if it's a $10 expense, do you need to take the 10 out of your HSA? Why don't you take a picture of the receipt? Leave it in your account. It's earning interest. It can be invested. Let the money continue to grow. Take it out sometime in the future if you want that 10 bucks. And so there is no time limit on that. I've got thousands of dollars of expenses that we've not taken out of the HSA, mostly because my wife knows if I die, it's her money. She doesn't want to spend the money out. But now we're nearing retirement. We're 3-4 years away from retirement and going to have over $100,000. I've got $80,000 in my HSA now. By the time I retire, I have $100,000. And part of it is the value that it's going to bring into retirement. Next slide, please. So what are the qualified expenses? Medical expenses, dental, vision, hearing. A lot of people don't know that medical plans don't pay for hearing aids, right? They can be expensive depending on where you buy it. All of these expenses can be covered from an HSA. And then premiums at age 65, which include Medicare, which I'll talk about more at length in just a second, but long-term care insurance as well. And that's part of a lot of people's planning for retirement is their long-term care insurance plan. And there's a schedule the IRS provides of how much is eligible to be contributed. And then COBRA insurance. And I mentioned COBRA insurance on another slide just to say that some people don't wait till 65 to retire. They retire early. But then often they have an issue in terms of healthcare, trying to get healthcare. Some people time it, a lot of public sector employees time it to use their COBRA insurance until they get to Medicare age so that they can use their HSA to pay their COBRA insurance. And then dependent expenses. So even if the dependents aren't covered by the medical plan, if they're a tax dependent, their expenses are eligible to be reimbursed from the health savings account. Next slide, please. Oh, there's at the bottom here, it just shows what's not qualified. What the two things that aren't are because now over-the-counter medicines and drugs, because of the CARES Act, is now eligible expenses, but cosmetic services and general health items like vitamins and supplements, health club dues, anything to promote general health, those are not eligible expenses. Anything that's medically necessary or for a specific condition is an eligible expense. Next slide. So as a savings vehicle, I like to say it's not your father's savings vehicle because there's no interest income tax on an HSA, right? So if I have money in a money market fund, I have to pay tax on the interest income every year. Not that they're earning anything now anyway, but if it was, and I did that for a number of years. We had an emergency savings account in case the hot water heater went out or some expense for our family. And I had that money and I was paying tax on it. One year I realized, hey, next time I have a medical expense, I'm spending that money out of that money market. Now the money's in my HSA. I just save the receipt. It's growing. I've got it invested. I'm going to take it out anytime in the future. So you don't have to spend the money out on an expense until you want to, and trying to get people to discipline that, to come up with a plan, kind of like just a process. How much do I want to take out of my HSA in a given year? And allow the rest of it to build and to continue to grow. Next, please. So as an investment vehicle, there's no capital gains, right? So if I've got outside of my retirement plan investments, I've got capital gains, but not if it's within my HSA. We can do the same funds as 401k. We have 13 funds that have been vetted. We have a registered investment advisor that we have quarterly meetings on those funds. We've swapped some of them out. But now today, as of last September, actually, we can duplicate the 401k fund lineup. And the advantage of that is now we can have the advisor involved in the educational meetings. When the advisor's talking about the retirement plan, they can mention the HSA. We can include models. The next one, please. We can do target date funds, whatever other people want to put in there. And there's no required minimum distribution on an HSA, so they can let the money ride until they want to. Next slide. So I just want to talk about it into retirement. And part of it's, I'm getting closer. I'm dealing with more questions from friends and stuff. And so I've just become aware of more things about it. But I think if I'd been 50 and understood this better, it would have been a good thing. So, you know, today Fidelity says that an average couple age 65 retiring is going to need $295,000 in after-tax dollars to pay for their healthcare expenses, right? The Kaiser Family Foundation said that retirees will spend about 3 times the amount on healthcare than the average working household. Next slide. So where's that money going, right? So 19% generic brand drugs, specialty drugs. So basically close to 20% for prescription drugs, 40% for Medicare Part B and Part D. And I'm going to talk to you about those premiums and what they cost. And then other medical expenses, the out-of-pocket, the deductibles, the coinsurance, other things that can impact their dollar. Next. So again, I just wanted to reference this. Some employees want to take COBRA to get to Medicare age 65. Their birth month is when they become eligible for Medicare. And so if they, within 18 months prior to that, they can use their COBRA. And the COBRA premium is eligible from the HSA. Next. So Medicare Part A, it covers hospital coverage, right? There's no premium if you've worked for 40 quarters or more for you or your spouse, but it does have a deductible, $1,408 deductible. And then it has some co-pays, $352 daily copay after 60 days. Next. So next bullet point. $176 daily copay for skilled nursing after the 21st day to the 100th day, right? So those are expenses people aren't even aware of. So there's just the idea that Part A of Medicare is, everyone thinks, well, it's free. Well, it's free if you work 40 quarters, the premium's free, but not the expense of it. It can still be, it can still cost a retiree some dollars if they're hospitalized. Next slide, please. Part B. Part B of Medicare is the doctor coverage, right? Premiums deducted from a Social Security check. Well, if I've got money in my HSA and I was hoping to have that money for spendable income, I can just transfer the money back into my checking account for my HSA, or spend money out of my HSA for those expenses that I want to pay for. The standard premium in 2020 is $146.60, but there's an IRMA involved for people who make a lot of money, and I just like to point it out that the income-related monthly adjustment amount is below there. So if your incomes are higher, you're going to pay more for those premiums. Now they look back every 2 years. So over time, someone who's just recently retired, if they've reduced their annual income down to lower levels, their premium will reduce as well, right? But again, it looks back every 2 years and then adjusts appropriately each year. Next slide. Now, Medicare D is the prescription drug coverage. There is no prescription drug coverage unless you take Medicare Part D. A lot of people aren't aware of that either. And there's a standard premium, $32.74, but it also has an IRMA, and these are the additions too. So add that additional premium based on your income to that. Now, it might seem like peanuts if you're making that kind of money, you know, kind of who cares? And yet I was told years ago, and it's so true, in our area, you want to meet the wealthy people, go to Costco on Saturdays. You know, they're at Costco shopping. They could shop anywhere they want, but they shop at Costco because they want to make sure they're maximizing their dollar. And in my mind, that's part of their retirement planning education if they have opportunity for an HSA. Next slide, please. So Medicare C is called, it's Medicare Advantage. So not everyone has a Medicare Advantage. You can really have a Medicare supplement, which is also called a Medigap policy, or you can do Medicare C. Medicare C Advantage plans are really county dependent. So it's the county in which you live in that you're eligible for that Medicare C. Now, it used to be everybody wanted supplements because it gave you more affordability in terms of travel, but now the Advantage plans, wised up to that, and they're providing other things. They might include dental and vision at no cost. They might include prescriptions at no cost. They might also have a travel accident plan included in it. And these vary year by year. And so those become part of the planning now for people that I know in the 2 states I really monitor, Minnesota and Arizona, the Advantage plans are actually outselling the Medicare supplement plans. Next, Ari. Medicare supplements, you know, they average about $230 a month. They're pretty stable, but they also renew annually. They're insurance product, right? So Medicare supplements or Medicare Advantage, it's up to each individual in terms of which they want to choose. Next. So part of the strategies, if you're a wealth manager or if you're doing education, some of the things that you want to talk about are bullet points. Build your balance. You know, bank your expenses. Don't take the money out. Don't take, you know, I have a $10 high blood pressure medication because I work with people like Ari. And I just, you know, I haven't taken $10 out of my HSA, you know, for years. I take a picture of the receipt. I got a mobile app. Take a picture of the receipts, archived at the website. Someday I'll count them all up, take the money out tax-free. Meanwhile, I have it invested, right? So bank your expenses, save your receipts, right? Make sure you've got a good tracking system. Our mobile app allows you to just take pictures. Again, they're archived at the website. In your retirement, if you've banked those expenses, now you can start tapping your HSA if you want to pay for those supplement policies. The Advantage plans are an eligible expense, but the supplements are not. And so by banking those expenses over time, and again, I don't know the number, but I would venture to say we have $4,000 or $5,000 banked of expenses we paid for out of pocket, maybe more. As I get very close to retirement, I'll go back and I'll count them up and see what we've got that we can take out tax-free, because again, we have those receipts. And then again, you can transfer money from your HSA to pay yourself back for any of those premiums B, C, or D that you incur an expense on. Next slide, Art. So what's the advisor's role? So I just want to really emphasize this because, as a matter of fact, right now I'm working with an advisor and an employer. You know, they've got a $400 million 401k plan, right? They've got a $2 million HSA plan. But that HSA plan with 800 employees started out with 90 employees taking it. And 2 years later, we're at 365 people enrolled in the HSA plan. And I'll venture to say, as word gets out, as they look at the numbers, the premium cost, the pre-tax savings, as more and more people get it, there's going to be 600 people on that HSA. And what is that $2 million going to look like, you know, 5 years from now, 10 years from now? It's becoming significant. And the employer really wants a coordinated educational program so that when they're talking about retirement and savings, they incorporate the value of the HSA. So it really is becoming more and more where advisors are getting involved. And again, I look at it and go, I don't know what the average 401k educational meeting is, but you're talking of 5 minutes to add HSA and do it any justice in terms of the additional features that people might be interested in. And again, we can duplicate the fund, so we can also pay the advisor. Now, I know there's all kinds of issues with broker dealers and all that stuff, and I don't know any of that. I'm on the insurance side, but I can tell you this: we have advisors that are getting paid. We have advisors that are some are getting paid on a stipend to do the educational work per HSA. So it's really up to the employer and the advisor in terms of how they want to work that out. But we have the capability to do that at Alaris. Next slide. Yeah, so here's the big deal. Turn to the next slide, please. It's education. One click, Ari, and I'll highlight it. So the number one concern among employers with HSAs is the education. That's the door. That's the door with what to walk through. What are you doing for education? I'll tell you what they did for education, because I was involved in all of them, in our marketplace anyways. You have an open enrollment meeting. You're going to talk about a high deductible plan. People are freaking out because the deductible is more than the plan that they had before. And now you've got, at the most, 15 minutes the first year to talk about the HSA and the value of the HSA and the fact that they will save money in premium and they can build their HSA. And some of the people get it. But in the second year, you get 10 minutes, maybe 5. And in the third, fourth, fifth year, you might get a brochure, right? So there's a huge issue in terms of the educating the population on HSAs. There's so much more information. We have videos available. I try to get every spouse, every employee to commit to their spouse watching the video, because I can tell you there's a magic when I showed it to my wife and she sees the value, security into retirement. She was hugely in favor of that. And most spouses are, but if they don't know it and you have to rely on the employee meeting alone, generally they're not going to get it. Next slide, please. So look at this. HSA participants are largely missing out on the value of investing their HSA dollars. 13%, that number fluctuates a little bit, but it's pretty close to 10% have invested their HSA assets. 54% didn't even know that they could. And that happens continually when I'm out doing meetings, talking to people. Even now with the Zoom meetings that we're doing, you know, they're asking about, are there investments? Absolutely. But see, often the employer doesn't want the focus to be on investments. Whereas with your 401k meetings, often it is about the investments. That's why it works so much better to talk about HSA with the 401k. 20% claim to have little confidence in the topic of investments. We even have a tool, and the advisor there's variables in the data to help them do fund selection where they can run through the tool, and it'll help give them categories of funds and what percentage in those categories to buy the funds from based on their risk tolerance. So a lot of employees are steered to that, but how much more if they could get a little more information in those meetings. Next slide, please. So again, yep, they're just not getting financial. You don't go to a benefits meeting to figure out how to invest things. I mean, you do to a 401k, a retirement plan, but often the open enrollment meeting has nothing to do with retirement. That's a separate meeting, and that's why the focus isn't there. Next slide. So at 65, from a 401k, I'm going to be taxed, aren't I? When I draw the money out to pay for medical expenses. But with the HSA, no tax. So what's the tax? What's the tax bracket of the participant? If they take 100,000 out of their 401k, what are they going to spend in terms of taxes? 15,000, 30,000 and you got to include state tax as well. So it just is such a great value in the retirement to have the money in there to pay for those medical expenses. Next slide, please. So yeah, as we align HSA investments with 401k investments, advisors will influence employees toward greater savings in investing. Next. So if you want any information on our HSA solution, you can contact me. Now, unlike Ari spelling my name with a S-O-N, those are Norwegians and Swedes. I'm a Dane, so that's S-E-N, right? So I only tell you that because of the email. Roger.jorgensen@alaris.com. Send me your questions. I'll be more than happy to answer how we go about training on education and what our HSA fee schedule is and those kinds of things.
You got a few questions.
Okay.
All from Mike. Are there situations where you feel an employee should save to the HSA first and then save to their retirement plan only after they have saved the max into the HSA?
Yeah, we always tell everybody, look, if there's a match on your 401k plan, that's free money. Take advantage of the match. Once you've done that, then look back at the HSA and max the HSA out. Then go back to the retirement plan and put more money in that. And I tell everybody, there's not enough money you can put in your HSA to retire on. So you must take advantage of your retirement plan and really incorporate that. But the HSA has some additional perks with the no tax, so you really want to maximize that.
So why do you think that most retirement plan record keepers aren't in the HSA business as well?
Yeah, that's a good question, because the owners of the TPA that I work for were retirement plan administrators, and that's exactly why they wanted the HSA. And the guys that I talk about that I know have over $125,000 balances, it's those original owners and some of the employees that started out because they totally got it. I think originally there wasn't expected to be any money in it, right? And matter of fact, if you look, U.S. Bank and Wells Fargo Bank, they were in early and out early. They looked and said, well, it's just not the deposits we were thinking of. Maybe the money moves quicker. Maybe they didn't want to spend the time and energy to really support that line of business. But for whatever reason, they bailed out. But I think now, once Fidelity jumped into the market a couple of years ago, I mean, that tells you that there's money there, and they see it as absolutely a growing area to have product in.
Last but not least, the biggest barrier to the HSAs is that you have to participate in a high deductible health plan, which not all employers offer. And even when they do, it's offered alongside other plans where it's very difficult for the participant to figure out which plan is less expensive. How can the argument be made to use the HSA/HDHP combo, even when you can't figure out whether or not it's the most expensive insurance option available to you?
Michael, I don't know you, but you have just become a friend. Okay, so, and here's why. I sat in a meeting, I had to do a presentation to our C-suite last year. And I got in front of them, and then I asked them, how many of you have actually gone to an HSA education meeting? Not one of them. How many of you are invested in, have chosen the plan with the HSA? 2 of them, right? There's 12 people sitting in the room. They don't even know what I'm talking about because they're bankers and for whatever reason. So I just challenged them. I said, you have got to understand how the plans. I mean, you should see how people favorably react to this. And then I did 3 educational videos for Alaris. I do this for clients all the time. And I did the young people starting out. How should you view your HSA? Middle age, how should you view your HSA? And folks close to retirement, how should you view your HSA? Now, Alaris has two plans as well, both with the same max out of pocket, which kind of helps. But they have a copay plan, and then they have a high deductible with the HSA. And I showed them in every situation, the high deductible with the HSA saves them a bunch of money. If they max out the plan, it saves them money. If they don't use the plan, it saves them money. But see, there's this intrinsically, I think there's a fear with a high deductible that could happen to me, but there's ways to work through that. Again, it's all about education. It's explaining to them how you can set up payment plans and make periodic payments, and the HSA can pay the provider directly on those, just trying to get through those hesitations. I've had more people come back to me this year, just in the course of work, because I interact with these people all the time. Thank you so much, because we signed up for the high deductible of the HSA, and we didn't spend the money out that we thought we were going to. This is a good thing. So again, it's all about education. You have to compare the plans. You have to show them. There's in the summary of benefit coverages that's provided to every employee at the end that shows how a claim's going to be paid. I use that right from the insurance carrier. The summary of benefit coverages to show them how a claim's going to be paid on the low deductible plan, and then how it's going to be paid on the high deductible plan. But then I add in the fact that there's this pre-tax savings on the contributions for the HSA. And if they only do what they've spent out of pocket, and you show that as a model, and you take one for the low deductible and one for the high deductible, the premium savings, if there's an employer contribution, and the pre-tax savings, the high deductible with the HSA almost always beats the copay plan.
Last question, can a plan participant contribute to an HSA when enrolled in a HDHP and a HRA?
So there's 2 types of HRAs that were created when the HSA was brought into place. One's called a limited use HRA that can pay just dental and vision. The other is called a post-deductible HRA. So you can have an HSA with a post-deductible. The post-deductible means you're going to pay first, the money's got to come from the employee up to the minimum deductible on a qualified high deductible health plan. That minimum deductible is $1,400 single this year, $2,800 family. Once $1,400 or $2,800's been incurred by a single or family, then the post-deductible HRA can begin to pay. So we do a lot, we call them stacked plans. HSAs first, and they can contribute up to the annual maximum, right, to $3,550 if they have single coverage, $7,100 if they have family. they can put that into the HSA, but maybe the employer has done it so that they only have 2,000 out of pocket or 3,000 out of pocket in the plan design, and then the HRA is going to kick in and pay. But a traditional HRA that is integrated with a non-high deductible health plan, or if it pays first, cannot be used with an HSA. The HSA's always got to pay first 1,400 single, 2,800 family in order for it to be able to use the post-deductible HRA.
Okay, great. Roger, thank you again.
Yep,
It's always a
thank
pleasure. I always enjoy the presentation because, again, I think that that's something where advisors need to get involved in. It's a great product and it's a great, savings vehicle, and they can make a lot of shekels on it.
Great, thank you.
Thank you. Of course, I'm last but not least. But before I present, again, we're going to do this again in 4 weeks from today, which is going to be October 23rd. And of course, that 401k virtual bunch, which we just did one yesterday with Ron Sellers. I always enjoy these events. Our next one is going to be October the 8th. Change of plans. Going to talk to Bill Shories, who is the National Sales Director, DCIO for Invesco. Bill is a great friend of mine. Bill is one of the two people when I came up with the idea with that 401k conference. He did not say that it was the craziest idea that he ever had or that I ever had. And so therefore, that's why we're actually probably here still to this day. So keep in mind, and in January, like I said, that 401k National Virtual Conference, we are going to have, it's a 2-day event. Consider it like a live national conference. You get everything except the food. I can't make, special delivery 100 or 125 or 150 different ways. But it's going to be a national virtual event over 2 days. Day one guest, Walt Frazier, New York Knicks, even to this day, still a broadcaster. Second day is going to be my good friend. Like I said before, he may not think so, but Dwight Gooden will be on day 2. We're going to have a whole bunch of people. Jake Rushton will be there, quite different few presenters. And of course, if anybody wants to be a part of it, running a special where if you become part of the January one and you sponsor, you could sponsor and be part of one of these monthly events for free. So reach out to me if you have any questions on sponsorship and whatnot. And to sign up for that 401k National Virtual Conference, we're running an early bird special from now until Thanksgiving. It starts at $20.21. You want autographs, pay $100 more. You want a t-shirt, you pay another $20 on top of that. But rates will be raised after Thanksgiving. So this is my presentation. If you saw that you were at the last virtual conference, it's the same presentation, just a little bit different commentary. I promise you the one in 4 weeks, we will not be doing this again. Everybody knows my favorite movie of all time is Airplane. So that's what we're going to do about it. Hence the title. Ari, what do you think of this? You can make a hat, a brooch, pterodactyl. Johnny, of course, my favorite character in the movie Airplane. A preface about my opinions. People kind of love my frank discussion on the issues, but of course, that's why I'm not invited to these large conferences and why I kind of started my own one. People don't like frank discussions. They like people who, sit on the fence, and I kind of don't sit on the fence. I usually fall on the fence, but really take my opinions with a grain of salt. I have a good track record predicting changes in the retirement plan business, but I've been wrong. And when I've been wrong really badly. I thought Apple starting their own stores was a really bad idea. I also thought that Amazon selling anything besides DVDs, books, and music was crazy. But again, what do I know? It's a changing world out there. And of course, thanks to COVID and political considerations, there is this election that's coming up in a few weeks. Facebook is telling me that there's an election because it's constant political fighting. But COVID will have a continuing impact on the retirement plan business for, on our business. We had the CARES Act. We had guidance on safe harbor contributions. We may get more guidance as this continues. Summer just ended a few days ago, and we're still being affected by COVID and lockdowns and whatnot. And of course, talking about politics, the DOL fiduciary rule. Of course, Democrats and many in the industry, which are, of course, RIAs, are against it. They're finding that there are too many loopholes. Any effective date or implementation is going to be well after the presidential election. And of course, like with the previous new rule, which 4 years ago, a lot of plan providers spent millions upon millions of dollars to comply. The presidential election will dictate whether it gets implemented or not. And so I was working with one firm dealing with that last rule change. And after Trump was elected, they said, you know what? It's not going to happen. Time's up. We don't need your work anymore. This rule is dead. And I thought they were premature. And of course, as it turns out, they were right. And again, like I said, I've been wrong before. The ESG Department of Labor view, the current administration takes a negative view of ESG funds. Quite honestly, it's all about politics, in my opinion. They say they want to look at, there may be issues because the idea of a fiduciary is all about, picking out investments that are best performing, and ESG funds are not. And the problem is, obviously, not, one ESG fund is the same. I mean, quite honestly, you could look at different companies and look at, what the investments are in the ESG funds, and you'd be surprised what some fund companies may consider ESG. They may be high, growth funds and whatnot. And again, the future is dependent on the election. If Biden will win, which again, depending on the polls, it's, to me, right now it's 50-50, it will die a very quick death. And of course, in consideration of what happens, especially if Trump does win re-election, which again, like I said, 50-50, and you have plans out there with the ESG funds, check the investment policy statement and see if there are any issues now. And again, a few weeks will tell us what the problems are. My favorite topic of late is pooled employer plans. So it's all about ball bearings and PEPs these days. That's a line and a joke from the movie Fletch. But pooled employer plans, we have seen this before. There are these little things or big things, depending on the plans you're working on, called open MEPs that prior to May 2012 had the same issues. I don't think it's going to be the game changer that some are making it out to be. J.D. Carlson, who you know from the Retireaholics, he's very against PEPs. I can understand it as a TPA having those issues because, the problem is that it could cannibalize your single employer, plan business. And quite honestly, it's all about collecting assets, as costs of an audit will be a PEP killer. There's nothing worse than a PEP that finally reaches the 100 participants. The 1,000 participant killer, where they had a employer that had more than 100 participants. If they don't have enough assets to pay for that audit or to be cost effective, there's nothing worse than an audit, charging a participant $50 a head just for the audit. That's where I believe the audit is always the PEP killer. And of course, with PEPs and different from MEPs, there's a higher, there's an audit exclusion, and as opposed to regular PEPs where it's needed. 90 to 95% of PEPs are going to fail. Instead of, everybody wants to have their own PEP. I'm an advisor. I want, this fancy, tricky, nice looking PEP. It makes me really look good. Consider partnering up. I'm looking to, possibly starting a mega PEP, just because I think there will be a need for it, especially for the advisors that don't have the book of business that support their own PEP on their own. So hopefully something will come out of my discussions with some of these providers. Some other considerations. Litigation is always going to be there. Mutual fund companies' proprietary products are going to get sued. My friends at Pentegra just got sued on their MEP. You become large enough. One of their legacy bank MEPs just got sued by Jerry Schlichter. And of course, the beauty of litigators is ERISA litigators have to eat too. And so therefore, they're always going to come up with ideas on how they could sue plans. And we saw the showcase where the question is whether participant data is a plan asset And if you're using plan participant data to cross-sell investment products or mortgages or whatever you're going to do for, is that you know, an improper use of a plan asset, especially by advisors who may be plan fiduciaries. So, you know, of course, other considerations, many advisors and TPAs have neglected their clients during COVID, which to me is opportunity time to pounce. I know that there are quite a few clients out there that have not talked to their advisors in the last 6 months. Travel is still going to be hard. Some firms have, you know, banned travel through April 2021. That's why, you know, I had hoped to have a Las Vegas event in December. Just being realistic, when a friend of mine from Lincoln said that she was not allowed to travel through April 2021, so I realized that certainly at the least I couldn't have any events that were in person. And hopefully we will continue with our events that were, you know, pushed back, which were Houston, St. Louis, and Minnesota. We have dates, and hopefully we can fulfill those dates. And again, even after there's a vaccine, I think that Zoom is still going to substitute many of these in live person meetings, whether it's participant enrollment meetings, whether it's these type of conferences. And of course, I didn't update the slide because I'm lazy, but yeah, the next, that virtual conference 7 is going to be on October 23rd, and then November the 20th. That 401k National Virtual Conference, again, January 21, 22, 2021, right after the inauguration on the 20th. Surely this isn't the end. And of course, yes, I remember I had the lasagna, which everybody knows is my favorite line in the movie Airplane. And if you didn't know, now you do. And of course, everybody knows my contact information because you get, you know, 2-3 emails from me a week. Questions. How much of ESG do you think will be marketing vis-a-vis the investment manager actually utilizing those factors? I really don't know. ESG to me, in terms of sector funds, that's probably the most popular. I don't know. I don't think it's going to have that greatest impact on most plans, just like you know, the Trump administration allowing private equity. Again, I don't think that is going to be something that we're going to see a lot of as well. For, you know, to me, it's just a niche product. And, you know, I don't think that it's really going to become an issue. And like I said, I think that, you know, I think everybody's taking a very cautious approach. And again, we have an election, and to me is, you know, people say one way or the other. To me right now, it looks like 50-50. And we'll see, you know, what happens. And, you know, after, I don't even know when election day is, but that first Tuesday after the first Monday in November, we'll see what happens, especially with the fiduciary rule, ESG, and, you know, obviously greater impact down the line. So no further questions. That is going to be the end of this event. And like I said, feel free to attend the, oh, so Greg always with the answers. November the 3rd is election day. Okay, everybody please register and go vote. And of course, like I said, that 401k National Virtual Conference 2021, to sign up, you want an autograph from each guest, they'll cost you a couple more shekels, but go to that 401ksite.com. Have a great weekend. And if you missed any part of it, it will be on YouTube later today. Thank you so much. Take care. Bye.